I'm going to do is I'm going to break it down little by little, definition by definition of literally what the stock market consists of. And then I will show you the exciting portion of what you possibly can do with your money. So let's just go ahead and start with it. So I want to start off with breaking down really what is a stock. Most people understand what a stock is, but I'm going to put it into simple terms for you. Let's say that I'm an individual who's really, really, really great at making lemonade. Everyone loves my lemonade. Everyone wants to drink my lemonade. But the problem is with my lemonade, I don't have a brick and mortar building to go ahead and put this lemonade out to other people. So what do I need? I need my family members and people around me to help me out. I need them to basically invest into my product of my lemonade. And that allows me to get my lemonade out to everybody. But when you're investing into my lemonade stand, you're asking, I'm asking you for your money, but at the same time, I'm going to be giving you a return back on your money once my lemonade stand is out there to the public. That essentially is what a stock is. It's a company that you have a percentage of. It's just that simple. Another part of that you need to understand is what are commodities? Commodities literally are just things that we deal with every single day. It's something as simple as gold, iron, silver, oil, steel, and soybeans. And that's what a commodity is. Understanding the third part of what the stock market is, it's bonds, right? So there's three types of bonds that are out there. There's the US Treasury bonds, the municipal bonds, and the corporate bonds, right? What a bond is basically IOU, right? The bond is the lender, which is myself, right? And the issuer of the bond is the borrower. And they give me a coupon. And once I get that coupon, I'm receiving interest on that coupon. So it's IOU, and it's usually a US Treasury, a municipal, or a corporate. So those three definitions that I just described, including currency, is literally what the stock market is, right? The stock market is just a place where buyers of those three things come together, and then sellers of those three things come together, and they're selling and trading at the same time. That's all the stock market is, just a place where they do those things at. So you need to understand, after what the stock market is, you need to understand like the different exchanges out there. And I'm sure most people have heard of the New York Stock Exchange, but I'm not sure if people understand that there's actually 13 registered stock markets that are operating in the United States right now. Obviously, the two most famous ones are the New York Stock Exchange. And what makes this one the most famous one is because it's the largest one. It has over 3,000 companies that are traded on that floor. The other one, that's the second most popular one in the US, is the Nasdaq, right? And that one is the second largest one. And that one has over 2,700 companies that are traded on the exchange. When I first started, I thought that when you do trades, everything goes straight through the New York Stock Exchange. I did not know that there's other stock exchanges out there, but there are 13 registered stock exchanges that are actually operating right now in the US. So have you ever caught yourself like looking at the news and you see like the stock market opening on Wall Street at 8:30 in the morning, and you see people ringing that bell, and you're kind of wondering what's going on? Why is everyone happy clapping their hands, right? Well, what you just probably witnessed is what we call an IPO, right? So it's initial public offering. That initial public offering is like my lemonade stand. Now that I've known I can get the investors, I'm going to put my lemonade stand on one of those different exchanges. Once I put it on one of those exchanges, like the New York Stock Exchange, I'm going to go up there and do an initial public offering. Once I hit that bell, my stock is now available for you to go ahead and purchase. At first, you never heard about my lemonade stand, but once I go through the proper stuff on the stock market, I do that IPO, and now you're able to invest in my stock, and then hopefully the stock rises and you're able to make money, I'm able to make money, and that is what an IPO is. Now, if you're interested in understanding where my lemonade stand is, if you missed my IPO, you can go ahead and go on New York Stock Exchange and look up my company. But you can't type in Gabe Pope's lemonade stand. You have to figure out what that is. So you have to type in what we call a ticker symbol. So a ticker symbol is an abbreviation used to uniquely identify publicly traded companies, right? So it may consist of letters, numbers, or a combination of both. So just two simple examples of a ticker symbol that you might be interested in. One of the oldest companies out there is steel, right? It's a commodity. So if you want to look up what still is, it's the simple letter X, right? You type in X and you'll know that you're able to look up still, and that's traded on the New York Stock Exchange. Some people are more interested in the newer technology. So if we look at Apple, you can't spell Apple on the ticker symbol, but you have to know the ticker symbol. So Apple's ticker symbol is AAPL. AAPL, yeah, PL. When you type in those, it'll pop up, and that is traded on the Nasdaq. That is not traded on the New York Stock Exchange. Apple is traded on the Nasdaq. So you have to understand what the ticker symbol is after the IPO happens, and then you can start looking up my lemonade stand and hopefully start investing in me. So now if you want to understand where do you find my lemonade stand, because there's 11 different sectors that make up the stock market, right? All these companies fall into some type of category. So I'm going to go over the 11 different sectors within the stock market so you have a better understanding. So the first sector you're looking at is called financials. So if you're interested in banking, if you're interested in investment funds, if you're interested in insurance companies, or even real estate firms, that sector, you will find those companies, those type of companies under financials. You have utilities, which is your electric, your gas, and your water companies. And then you have consumer discretionaries, which is your retailers, your media companies, on also consumer services. You have consumer staples, and this is where you'll find my lemonade stand. Consumer staples, that sector consists of food and beverage companies. You have energy, which consists of oil and gas. You have healthcare, which consists of biotechnology companies, hospital management firms, and medical devices. And then you also have industrials, right? So you focus on aerospace and defense and machinery and construction. You have technology, which focuses on electronics, software development, and information. And then you have telecom, which focuses on wireless providers, cable companies, and internet services. You have materials, which focuses on mining, refining, chemical, and forestry. And then the last but not least, which Dan loves, and then if you ever want to look up Dan's company one day, you go to real estate. In real estate, it focuses on companies that are invested in residential and industrial and retail real estate. All right. So now you have an understanding of what the stock market is. You have an understanding of what the exchanges are. You know how to find the IPO based off the ticker symbol. Now you're able to find my lemonade stand within the sector. But let's say you don't want to trade just my lemonade stand. You want to trade that entire sector itself. Well, on the stock market, you can trade something called ETFs, right? These things are called exchange traded funds. They're traded on the stock market. And like I said, if you're interested in these sectors I just described, an ETF might work best for you. And it's traded just like a single stock. There's pros and cons to both. But if you're interested in that, you can trade the whole sector, just not the one stock that's the company, which is my lemonade stand. How do you rate the US economy going up and going down? Well, what they did is they decided to create things called indexes, right? These indexes measure the economies of the US. There's a lot of them out there, but the three biggest ones out there that can help you make a quick, just look at it real quick to be like, did the GDP of the US go down or up? Is the first one is the S&P 500, right? The S&P 500 stands for the Standard and Poor. What the 500 is the 500 companies in the US stocks, right? It's the top 500 companies in America. These 500 companies make up 80% of the value of the US stock market. All of those companies together, just these 500 make up 80% of them. Then you have the Dow Jones Industrial Average. This is one of the oldest indexes, okay? This is 30 of the largest and the most influential companies in the US. And the last but not least is the Nasdaq Composite Index. This one really is a whole bunch of tech companies. So if you're really, really interested in seeing if the tech is going up or down and you're kind of nervous, you can literally just type in this index, that ticker symbol, and then look and see all of those things come together on the Nasdaq Composite Index. All right. So you have indexes, which are great, but then you also have something that everyone pretty much has heard of, are mutual funds, right? I have a mutual fund. I'm sure you have a mutual fund. But what is a mutual fund? So over 100 million people have mutual funds. These are professionally and actively managed, right? This can consist of 100 stocks, 100% stocks, 100% bonds, 50% bonds, 50% stocks. Literally just look at it as like a basket of what you like. And the reason you have 50% bonds or 50% stock is depending on your risk, because some people are not as, I would say, they're not able to take a real roller coaster. That's why when you go to like Six Flags, there's different types of roller coasters out there. Some people are scared to go on some people are brave to go on some. It depends where you are in your life, right? It depends. If you want to be heavy stocks, you're nice and young, you want your mutual fund to just be a basket of stocks. I don't care if it goes up and down, I just want it. You're a little bit closer to retirement, so you want to have 70% bonds and then maybe 30% stocks, because you know that bonds are a little bit, maybe possibly a little bit more secure at that time compared to stocks. And a lot of people need to realize is you have fees that are associated with mutual funds, but that's something that you can go and look at. So an example where you would find mutual funds, you'll find it in your individual retirement account, your 401ks, and anyone's military, that you know that a 401k is equivalent to your TSP. That's it. And if anyone has their own business, like Dan one day when he gets out of the military, he's gonna have his own business. So he needs to invest in a 403b. All that means is all three of those 401ks, 403bs, and TSPs are all the same thing. 403b is just for someone who has their own, they're self-employed and they want to start investing in their own future. There's caps on each one of these, $6,000 for IRAs and $19,000 for 401ks or TSP. So there's a limit on how much you can invest. And that's why I'm teaching you this, because these things are capped, but you will understand the power of the stock market is unlimited. So understanding these and not just going with what your employer tells you, you will understand, I can make so much more money than what they're topping me out at, okay? So now that you understand how the market works, if anyone's ever been to the New York Stock Exchange, you have two different types of animals outside the New York Stock Exchange, right? You have a bear and you have a bull. The bull, if you've ever been to Spain, or if you ever watched like one of those, what are they called? Not a bull show, but when they're chasing the bulls or whatever. When a bull comes at you, most likely when you're watching it in the stands, that person who gets hit by the bull is going to go up in the air. Okay, they usually don't go straight down; they go up in the air. So the reason there's a bull outside the New York Stock Exchange is because that means it's a bullish market. You ever heard of bullish market? It means it's just going up, right? So if a bull hits you, you're going to go up in the air. The reason there's a bear next to it, that no one ever takes photos next to the bear, is because a bear, if you ever watched the Leonardo DiCaprio movie, The Revenant, you see that every time he gets attacked by the bear always pins him down. He can't go anywhere. He's always going down. So when you think of a bear, it's called a bearish market. So a lot of Americans like a bullish market. A lot of people don't like a bearish market. So when you think of a bullish market, you think of it going up. When you think of a bearish market, you think of it going down. Now there's two other words I want to go ahead and describe what an up and down market means. So when someone says, are you long in that stock? What does that mean? It means, are you up in that stock? Long just means up. So long and bullish go hand in hand. And then with bearish, people say, are you short? And if you ever watched the movie The Big Short, it's about investors who basically shorted their positions when the market was going down. So all short means is that you shorted a position. That means, are you shorting it? That means, is it going down? Now I'm going to teach you options trading, which is what I love to do. And I'm just going to jump ahead a little bit, but there's two words that go with up and down in the options world, right? So you have a call and you have a put. So when I'm calling you, when someone calls me, which I never pick up the phone for people, but if it's my boss, maybe I might pick up. Hopefully he's not listening, but I don't really care. Anyways, if he calls me, I'll pick up the phone. It's a call. So I'm picking it up. That means it's going up. Once I'm done talking to them, I'm going to put the phone down, right? And that means I'm putting it down. It's a put. A put means down. So when you look at the market, when people are talking about, oh my God, the market's going down, the market's going up, be a person who understands what they're saying and tap into your financial IQ and say, It's not a down or up market. It's a bearish market. It's a bullish market. It's a long market. It's a short market. I'm putting in a call position. I'm putting in a put position. Okay. So understanding that would definitely help you understand the market just a little bit more. Now, we all drive a vehicle. For the most part, we all drive a vehicle. And with that vehicle, we do something called insurance on that vehicle, right? My car, honestly, is like $400. So I'm cheap. But my vehicle's $400, but my insurance per every 6 months is more than my vehicle. I get no benefits of having insurance besides the peace of mind of that insurance. What that insurance does is I pay it every 6 months. I don't get anything in return. I do it another 6 months. I'll get anything in return. So think about this. If you have $10,000 in the bank, you have $150,000 in the bank, you have $250,000 in the bank. Wouldn't it be nice to put some insurance on your money instead of it just going down and you're sitting there thinking, damn, what happened? Well, we call this hedge. We hedge our positions. We protect our money. So let me give you a quick example. If you have 1,000 shares in Apple, because on Friday, if you want to look it up, Apple closed at $318. I'm going to round it up by 2 to keep it simple. Let's just say it closed at $320. You wake up on Tuesday morning, because we can't do it on Monday, because remember, the stock market is closed on holidays. So you wake up on Tuesday, you hear the ringing bell, and all of a sudden something happened with Apple over the weekend that you didn't know about, and your 1,000 shares, Apple decides to drop by $10, and you didn't even realize it. You didn't hedge your position. All of a sudden, you lost $10,000. That would make me sick. So if you understand, you could use the power of the stock market and hedge your position so you don't lose money, just like you do every single day with your car. All right. So there's different types of traders that you guys need to understand, right? Have you guys ever heard that person that's in the office talking about oh man, I'm chasing stocks and I got the newest and greatest stock and look how much money I've made, and you think to yourself, my goodness, they're so smart. I'm not as smart as these individuals. Well, let me tell you a story real quick before you start praising these people who make all this money and stuff by picking stock without physically and mentally doing the preparation, analyzing the stuff. Back in 1592 in Holland, there was these things that were called tulips. And if you know what a tulip is, it's just a little tiny flower, right? These little tiny flowers became so popular in Holland. They were used everywhere. They were used in festivals. They were used in paintings. And they termed it the tulip mania, right? The price of these tulips became so expensive that eventually it made the market crash, right? There was no true value of that tulip. But since everybody wanted it, it made it go up and up and up. And really, in reality, things can't keep going up and up and up. There's going to be a burst. And everyone's heard of a bubble. Remember 2018 or 2008, the housing crisis, Lehman Brothers, all those things, the financial crisis happened because everything went up and up and up. No one really looked at it. Well, in 1592, that was the first bubble that's ever happened. Basically, what I'm trying to teach you is we put value on things that are popular. And what I'm going to show you is 2 different traders who understand the market and are able to make money on the market. So the first trader you have is a fundamental trader, or we call them a fundamental analysis trader. What these people look at, they're more for the long term of things, right? So the long term, when I look at a company like Gabe's lemonade stand, I'm going to look at, first of all, who is Gabe? Does he have good character? Oh yeah, he's an outstanding guy. Does he have good financial decisions? Oh yeah, he does. Does he have good product? Oh, amazing product. What is his PE ratio? I look at the holistic portion of that company. I look at the history, and I make a determination based off my fundamental analysis of that company. Then I jump into that stock because I believe it's gonna be beneficial in the long run. Then you have technical traders, and this is kind of what I like to do. I'm both fundamental and technical. We call them technical traders or technical analysis traders, right? You ever heard of day traders or swing traders? These people are in and they're out. I'm more of, I like to get in, I like to get out. I like to get a quick paycheck and then move on, get another quick paycheck and get on. I like to look at it as a monthly income. I don't want to hold on to something for so long. I want to get monthly income. Now, let me back up a little bit. People who do fundamental trading, they usually get into stocks that give them derivatives. Those derivatives pay them when the monthly or when the quarterly statements come out. It's close to the quarterly statements. It might be the same thing as quarterly statements. But when people have a lot of money in stock, you wonder, how come they never pull their money out? How do they always get paid? Well, they get derivatives from it. That means the company's made a lot of money, and then the company has decided to go ahead and pay their shareholders because you've been such loyal customers. I'm going to pay you because I've made a lot of money, extra money. So I'm going to pay you maybe 50 cents per share, 5 cents per share. And that's how these people are making $10,000 per stock without ever pulling their stock out. Does that make sense? All right. So going back to technical traders, right? When you're a technical trader, you like to do something called look at charts, right? So have you ever wondered, without looking at any information, how can I look at a chart and find out when did the stock open? When did the stock close? What was the potential volume for that day? What was the potential movements of price up and down? What was the high for the day? What was the low for the day? And like I said, when did it close and when did it open? They created charts for you to look at. And the power of the information by looking at a chart is extremely important to making a quick decision without having to use any additional information. So I'm going to tell you the 3 top charts, and the last one I'm going to tell you is the one that I think is the most beneficial for you. So the most popular charts you'll experience is, the first one is a line chart, right? So looking at a line chart, the interesting thing about a line chart is it's very, very simple, right? It's just a real quick line. And I'm going to show you real quick what a line chart looks like. So if you look here, you'll see a line chart, and you see all these, there's 3 of them on there. Well, what you're doing is you're comparing one stock to another stock to another stock. And that's a really cool thing to have a line chart, but it's not really telling you much information about that stock. It might be able to tell you like when they're passing each other, and you might be able to make like a technical decision based off of just looking at that chart. That's great about a line chart, but there's also another thing called a bar chart. A bar chart will give you a little bit more information of what's important. So if you look at a bar chart, it looks like this, right? So a bar chart, they're very similar to a line chart. However, you're able to gain more information from these charts. So the top represents the high. And when I say the high, that means the price that it went all the way up to the high of the day. The bottom represents the low of the day. How low did that stock go? The line on the left of that stick represents where the stock opened. So remember the opening bell, that's the open. That's when it opened. And then the line on the right represents when the stock closed. So when the stock market closes, because it opens like work and closes like work, that's when it closed. So just looking at that, that's when you understand, oh, I can look at that stick for Gabe's lemonade stand and be like, it opened at $500 today. It went all the way up to $600, but it closed all the way at $580 just by looking at that stick. But the best thing is that I love to use is called the Japanese candlestick charts. And most people have seen these. You just probably seen it and was like, that's fearful. I don't know what that means. So I'm just going to look at the information that's scrolling around. You can look at that chart and tell yourself so much about what is on there. So a Japanese candlestick chart looks exactly like this, right? The rectangular blocks with lines that come out with them that look just like a candlestick, right? The top of the line, it represents the high for the day. The bottom of that candlestick represents the low. And then you will see that there's 2 colors, right? If the candlestick is green, that means it was a buyer's day. Remember, you learned the word bullish, right? So it was a bullish day. If the candlestick is red, that means it was a seller's day. They're selling a lot of things that day, and that means it was a bearish day. So looking at these charts, you're able to like really look at it and understand really quickly of how you can analyze something. And that's why I consider myself a technical trader, right? Looking at multiple charts of candlesticks, you start to come up with patterns where you can kind of predict if that stock is going to go up that day, down that day. It just depends. And that's why you got to do your homework and understand it. So there's different types of trading, right? When you look at the stock market. Now, for like for Gabe's lemonade stand, most people look at the stock market and they say, I'm going to go buy Gabe's lemonade stand. I'm going to go buy that stock, right? All that means is I'm buying a stock and I'm hoping that it goes up. It's a 50-50 chance. I don't really like 50-50 chance odds. That doesn't go in my favor. Unless I have a lot of extra cash, sure, why not? But I would rather have something that's a little bit better than 50-50 chance. But that's really what a stock is. You're just buying it and you're hoping it goes up. Or remember, you learned the word shorting it. You can short a stock and maybe it can go down. 50-50 chance, but you have to go one way or the other. That is just stock trading. You have trading called Forex trading, which is the ability to trade currencies. So you have the US dollar, right? You have the yen, you have the pound, you have the euro, you have all these other currencies around the world. You can go and trade other people's currencies against the US dollar. You can go trade the yen versus the pound. There's different types of trading you can do in the stock market for Forex trading. Then you have futures trading, right? So what is futures trading? Basically, futures trading is a contract of parties. They're looking at an asset and determining at a predetermined future date. Basically, I'm purchasing something at a current date, a commodity, right? Like oil, grain, whatever it is. And regardless if in the future, if that price goes up and down, I've already made that predetermined price. So I keep it very simple if that confused you. I believe that grain is going to go up in October. I make a futures contract in the month of April. That grain is going to go up in that month that I just said. I pay whatever I got to do. And then when that time comes, if it went down, I already made a futures contract. That's all I can do. If it goes up, that futures contract that I made, I won. There's so much more detail to it than you think, but you'll realize that's just the basics. And all I'm trying to do is open your eyes to, you don't just have to trade stocks. There's so many other things. I'm going to show you what I love to do. I love to trade options, right? This is what I love to do. So options, it might sound kind of confusing, but I break it down very easy for you, right? So options are a contract that allows an investor to buy or sell an underlying instrument like a stock or a ETF, which you learned what an ETF was, and an index, which you learned what an index was, at a predetermined strike price, which is the price of the stock at a certain period of time. Options, basically, you don't keep them. Now, when I get a little bit more in depth, you will keep them. It depends, right? But an option is something you kind of don't really have. So if I want to go and look at Apple, my God, damn, Apple's trading at $320. I can afford that. Well, I can go into Apple and buy the options in Apple, and I can get it. I can get like one contract, which is 100 shares of Apple, maybe for $500, $1,000. That's the power of options. That's the power of understanding your financial IQ. Don't be tricked by looking at people saying, wow, they're so rich. They can just buy stock all the time. And I just have to stick to my TSP, my 401k, and mutual funds. No, you can go in and understand things a lot more differently, right? So options, these trades take place on the New York Stock Exchange, and they take place, you can trade them on the Chicago Board of Options. So there's actually a market in Chicago as well, right? And the beautiful thing about understanding options, it gives you the power to either earn income, to speculate, or to hedge. Remember I told you about hedging, like car insurance, right? So if I have stock in Apple, it's at $320, I'm going to buy a put option. Remember I said a put option to hedge my position if it goes down. So I'm going to buy it at, I don't know, $300. So if Apple goes down to $299, boom, my option kicks in, and I made sure I saved myself. I didn't just go on vacation and all of a sudden I come back and I realize I'm broke. No, I hedge my position. And you know what? If Apple never goes down, I don't care. I bought that put option to give myself peace of mind. The next couple months, I do the same put option. The next couple months, I keep doing the same put option. I just keep letting it go and go and go. Just like you do every day with your car insurance. And that car value doesn't even go up. Your car value goes down. So stocks usually go up. Why not protect it with options, right? Does that make sense? So the market can go up and down and make you money and go side. Well, let me back up a little bit real quick. The market can go with options. You can make money if the market goes up. You can make money if the market goes down. You can make money if the market stays the same. It depends on your strategy. And there's so many strategies with options trading. I'm just going to share one with you really quickly before I end this. I don't know if you guys remember, but back when Brexit happened, right, the stock market went crazy, right? It was like going down, and going down. But since I kind of understood options, I was like, let me make an educated, calculated guess right now and buy a put option. So what I did was I bought a put option in the Russell 2000. You'll understand what the Russell 2000 is. It's like the S&P 500. The Russell 2000 is 2,000 under $1.1 billion companies, right? So companies are not making more than like 1.1 billion, 2,000 of them. I didn't buy just Apple. I bought 2,000 companies, and it's all in an index called the Russell 2000. I bought a put option in there. The put option was only good for 3 days. Usually you don't do this, but I was like, you know what? Chaos is happening. I'm going to make a decision. Because if you look at the news, you always see how are people getting richer and richer and richer when the market's going down. So I was like, let me make this decision. I know the market's going down. So I bought a put option in the Russell 2000 when the Brexit happened. And basically, the market returned where it was supposed to. And within 3 days, I made $5,000. Now, don't get it mixed up. You can make $5,000. You can make money quickly. But remember when I introduced myself, I said I made every single mistake possible. And what I did was with that $5,000, it got me hungry to keep going and going and going. I had no clear vision. That's why I did everything backwards, and I ended up losing some too. So if you have a clear vision and you understand what you're doing, that $5,000 could be a blessing, or that $5,000 could be a curse. Now, remember, it's just not $5,000 that you can make. You can make $100. You can make $200. You can make, I don't know, $1,000. You can make this at a monthly increment on top of your job. So now you have multiple vehicles. And one thing I love to tell people when I'm training them is all of us are starting, and nothing against California, don't take it the wrong way. I grew up in California, but everyone starts in California and everyone wants to get to New York. So we all start together, right? And we're all walking. But all of a sudden you look to your left and you look at me getting on a bicycle, but you don't even understand what a bicycle is because you're still walking. And I'm like, you know what? I want to get off my bike and I want to get on a train. I'm long gone. I'm enjoying the view. I'm tired of that train. I want to get in the 18-wheeler. I get on the 18-wheeler, I'm back on the road. I'm tired of that 18-wheeler. I then jump on a private plane. I'm in New York enjoying myself. I enjoyed you know what you're doing? You're still walking. It's because if you look at that analogy and you understand that it's about having multiple streams of income. If you lost your job, what other money are you making? Are you making any other money? And I'm basically saying we're all starting with a job in California, but we all want to get to New York. If you lost your job, you don't know what else to do. So if you understand different aspects, and that's why me and Dan are coming together, just to show you the potential of understanding different types of ways to make money without technically going into work. This is available to anyone. So if I make money, it doesn't mean I'm taking money out of your pocket. So that's why we wanted to come here and just give back to you guys. So I just want to end with the different type of platforms really quickly that you can use, right? For trading, you have different platforms, right? So you have an automated system, which is for passive investors. Remember when I introduced myself, I said I'm an active investor. I also am a passive investor. Passive investors are for, your IRAs, your 401ks, your TSP. Now, you could trade your IRA. You could change it from passive investing to active investing. I took my IRA, I let my bank put it in mutual funds and trade it. It made no money. I took my IRA and I traded it for an entire year. I tripled my IRA. Then I put my IRA back into the automated system and I wanted to see what it would do. And it was very boring and it hardly made any money. So that's the power. Or you could take your IRA, from an active system, trade it, and lose all your money. So it depends, like I said, on the roller coaster. If you like roller coasters and you're a risky person, good for you. If you don't get on it, because this isn't for everybody, right? Stick to the automated system, stick to the slow investing. If that's what you want to do, you're 65 years old, you make your $1 million, that's good for you. It's not good for me. So that's why I do what I do. You can have the active investing, right? So I'll just give you a couple of accounts that you could potentially look into, right? So you have E-Trade, which is a good one, Ally Invest, you have Fidelity. The two that I've used over my time is one from TD Ameritrade called Thinkorswim, right? So this guy created Thinkorswim with his team, sold it to TD Ameritrade. Then he decided to come up with his own team called Tasty Trader. Tasty Trader is for option traders like me. If you want to go and buy regular stock, you can use this platform too. One thing you got to keep in mind, it's all free. It's free. It's good for fundamental traders and technical traders. You can get so much information from these platforms. When you look at these platforms, it's going to be overwhelming with information, but don't be scared. If I can do it, you can do it, okay? And I leave you with this, right? At the very end of the day, all the stock market is emotions. People are scared. People are happy. Whatever it is, it's just emotions. There's no, what is the value of that tulip I just told you, right? What is the value of that tulip? People are happy about the tulip, it means a lot of money. People are scared about the tulip, it means it's $0. That's all that, you can't control people's emotions. That's why you can't control the market. But if you can understand a lot of this stuff, you have a better chance of controlling your money. If you want to write these things down for like a couple of websites I have, if you want to look at some stuff, you can look up Yahoo Finances or Market Watch. I highly recommend everyone watching this video. I make everyone watch this video before they start really talking to me. It's Ray Dalio, how the economy works. This will blow your mind. It's very simple. I know we're all smart, educated people out there, but this video is just really simple. It breaks it down. I already told you about the two platforms. One book that kind of changed my mind. Shout out to my boy Wallace back in the day, he put me on this, but it's called Rich Dad Poor Dad. Some people don't think it's fictional. Some people think it's non-fictional. I mean, I don't care what you think it is. It's just a good book that kind of separates your mind to stop thinking about a job and maybe thinking about the entrepreneur aspect of it.